Meantime, it is a busy month for central bankers, starting tomorrow with a closely watched ECB decision and followed by the U.S. Federal Reserve's meeting next week. We're joining us now to talk about what all that might mean for markets and how markets are operating in general. Chris Retzler, he's portfolio manager at the Needham Growth Fund, and Brian Luke, global head of fixed income indices at S&P Dow Jones Indices. Guys, good to have you here. Chris, we were just talking 2 days. Almost dead flat S&P 500, lots of movement below the surface. Everyone's been talking about this rotation out of these kind of crowded growth momentum stocks into cheaper value stocks. How does that influence you as a growth manager? Do you think this is a real shift or just kind of a mechanical adjustment here?
Look, it's real. There is a rotation going on. We're thankfully benefiting from it because we're more of a value investing firm. So the momentum growth names for people were crowded over the summer where they were looking to buy growth. Those valuations got a little too high. So we are seeing that pull back. So for us, it's working well. Do I think it's going to continue into the long term? Probably not. I think there's going to be some good buying opportunities this fall and probably some of those high growth names. We're not in the camp of a recession. So we think that, 2020, as people want to get reelected, the growth's going to come back. And we're just going through an air pocket, over the last couple quarters. And, we're still pretty bullish on the outlook.
If growth, meaning economic growth, is going to come back, meaning it's going to firm up, doesn't that mean that it's value stocks that might actually continue to be the outperformers? Is that the way you would be positioned?
We are positioned that way, that value is seeing inflows out there. Right. If you look at the Russell value over growth, that's certainly outperforming the last few days. That's how we've been positioned, so we've benefited. There is legs to it, but I wouldn't count out some of the growth stocks, some of the software names that are really high growth. I think there'll be some great opportunities there to put money to work.
Brian, if the market's been dealing with kind of how things overshot in certain directions in August, obviously fixed income is right up there. We're seeing a pretty pronounced rise in Treasury yields. The corporate credit market remains very firm and very busy right now. How does it all speak to you right now?
Yeah, we've seen about a 25 basis point rise in the 10-year. It's amazing. Last year, we were over double the levels we're seeing in the last couple of weeks. So you see a huge rally where Jamie Dimon was calling for rates to be higher. What has that meant for fixed income? Well, S&P U.S. Aggregate Index is up over 8.7% year over year. Compare that to the S&P 500 at 3.7%, a little more than double. You look at even the Treasury Index, the U.S. 10-year Treasury Index that we have is up over 14%. Investment grade bonds, 13%. Everything's green that we're looking, and we're looking across all of the world in terms of our fixed income indexes on a year-to-date and a year-over-year basis. Almost everything we're seeing is just positive, but we are getting some volatility now in the market.
I was going to say, the people who think that bonds have gotten too overloved, they'll start with those numbers you just recited. In other words, the returns have been so good and a lot of money has chased those returns, and therefore maybe just the pendulum has to swing away from there. Yeah,
I think that people want to see what level of yield that they're attracted to. I mean, whether they want to have something that's stable and value, but not necessarily chasing 10% returns. When I look at the market, I think the municipal bond index that we have is yielding about 1.6%. After tax basis, you're getting up around 2%. Would you take that over a Italian 10-year at 1%, a Greek 10-year at 1.5%, 1.7%? These are on an after-tax basis yielding higher than those.
Yeah. Although, Chris, somebody would say, well, I'll take the S&P at 2% dividend yield and take my chances with how it performs.
Yeah. Well, look, we view the steepening of the yield curve that we've seen in the last week as a bullish indicator, because you're moving away from that recessionary concern, which we didn't think was a real signal. Mm-hmm. But, a steepening of that yield curve is really good, and it broadens out, I think, the participation in the marketplace. Thereby, your value names are beginning to perform well.
Pattern has been go into a Fed meeting, Powell kind of disappoints in one way or another. Do you think the market's setting up for something like that?
I would say that we're probably pretty sure that there's going to be a cut here coming up. But longer term, I think the Fed actions are not as significant. I think what we really want to see is resolution to the trade, and I think that that's probably what we're going to begin to see. We're hearing some of that today. But look, the supply chains that we talk to, the companies we talk to, he is right. They are moving out, and they're making the right decisions, and that's why capitalism works, because they can make those decisions on their own.
All right, got to leave it there. Chris, Brian, thanks a lot.